easy and clear to see trend line on the way down. If you're going to look at multi-candle trend line failure, first of all, it has to break above the trend line. It closes obviously above it, because this is different to the single candle, single wick. And what's that supposed to do? Well, the reason why these are actually quite good, and I would actually be more of a fan of this rather than traditional trendline trading. Traditional trendline trading would say you buy here. Because I'm not a massive fan of trend lines, and I think they're not an objective way to trade, that logically leads me towards saying that people who use trend lines exclusively and put a lot of stock in them are probably not going to be as disciplined or consistent of traders. Just because and this is not a knock on anyone who uses trend lines, I've used them. But if you can't objectively define what something is, you're less likely to have robust, back-tested, real data, systems, and a consistent approach. Because every trend line is different, right? You can't say this trend line is, like, how do you define it? It's drawn across the 3 wicks. Okay, but also there was a trend line here across these 2 wicks. So is this a trend line? Yes. Is this also a trend line? Yes. Are these the same? No. So you see, once you start to try and think of rules for what a trend line is, you'll realize quite quickly that trend lines are very, very, very subjective. It's completely up to me where I draw this. I could also draw it like people do. I could also draw it across the candle closes, which would look something like that. You draw it across the candle close and this candle close, and then you let it run, and then you look at it that way. In that case, we haven't even broken out. So some people's trend lines, which are using candle closes, would be not a breakout here. Other people's candle closes, which are using, should get that, there we go, which are using the candle wicks, that is a breakout. So, whether you use them or not, I personally would be more of a fan of using them on the failure side because of what I just said. Because trend lines are probably the most likely type of setup to fail out of all of these, right? In terms of a horizontal breakout versus a trend line breakout would have a higher propensity to fail. A horizontal breakout is more likely to actually succeed. And again, that's something you can go and test. So multi-candle trendline failure would look like this. Obviously, you have multiple candles, and then it reverses. The good thing about these is that you have a very clear target, which is new lows. And obviously on the upside, new highs, which I'll show in a sec. The reason why your target would be new lows or new highs is because the trend line itself always denotes a trend. That's why it's called a trend line, obviously. But the good thing about that is it means you know the primary trend. So the trend line breakout is actually counter to the trend. You understand? A horizontal breakout, whether it's false breakout or not, can often be with the trend. You could have an uptrend that's trying to break out for a new upwards leg. But a trend line breakout will be a downtrend that's trying to turn into an uptrend. So what is that? That combines 2 things. A relatively subjective level, like a trend line, or subjective analysis, like a trend line, with a breakout attempt, which people will want to buy into, and it's counter trend. So people trying to long into this are actually going against the trend. The trend is down. And so if that fails, because you're in a downtrend, if that fails, what is that? That's a lower high. Where should a lower high lead to? A lower low. So then you know your target, which would be new lows in this instance. And then over here on this other one, your target would be new highs. And so you have a trend line wick failure here, same way on the upside. Price moves up, it consolidates. You can see the trend line draws nicely across the wicks and the wicks and the wicks. It has a single wick, false breakout, so it comes down and back inside. At that, where would your target be? New highs. So you pick the highest point before the false breakout, and eventually price makes its way up there. So you can have just the wick, you can have multiple candles. The point is, of course, if people are using trend lines, you can potentially go against them. Again, in this one, the trend line itself was in an uptrend, no doubt. The attempt to go lower was counter trend. It then failed, and price continued in the direction of the previous trend. Now, it might look good, what I've just shown. Like, it might seem really good and seem really easy. I want to make another point. I'm not bashing trend lines, although I am bashing trend lines. I've picked out a couple that work, and I've picked out a couple for as we always do in lessons, right? You're supposed to show something the way it's intended to work. Same thing with horizontal levels, right? Not all of these will be false breakouts, of course. Sometimes you get a proper breakout. And that's obviously what you should be hoping for if you're a breakout trader. Boom, there's a real breakout, not a false one. The problem with trend lines is that that's the high. That's it. There's nowhere else. That's it. That's the high. It has to break out there, okay? The problem with trend lines is when you don't have these really nice clear setups, which do come along every once in a while, like these ones, if you just go randomly on the chart, where do you draw your trend lines? Right? And this is how you can get into, and I see this all the time, you know, like you have one here, which is like that. Okay, there's one trend line, right? But you can also have, well, why is this not also a trend line from the top wick to the complacency bounce up here, right? There to there, and so on and so on and so on. And you can have fucking trend lines all over, trend line across these levels here. And very quickly, it can end up with you having one of those fucking laser charts like the Apu meme, where it's just lines everywhere. And maybe it'll work for some people. I find that, at least for me and for thousands of people I've spoken to, students, adding more things with sort of subjective context, like it's not like you're saying these are definitely trend lines and these are not, like a horizontal level is a horizontal level. You're adding in more subjectivity. You're going to have a very messy chart, and you're going to be potentially led into kind of analysis paralysis, meaning there's so much going on, you see so much, you don't actually know really how to action any of it. So that would be one other note of caution I would say about using trend lines. And so GM to that. Next, entry and invalidation. This is where the rubber meets the road. This is really what matters, right? What good is a false breakout if you don't know how to trade it? So these are just suggestions. Many others exist. Test them. I say that because it's really easy to come on these weekend workshops and just take what I show and think that that's the only way to do it. It's not. There's loads of ways, right? You can find other entry reasons. You can find other invalidations. You can find other targets. And you should. You should test different things. So that for two reasons, you should test different things, because if everyone does the same thing, they're probably not going to get a good result. Just that herd mentality. And you should just naturally be seeking to optimize and improve, right? If you build a system and it works first time, great. But there should be something in your head, you know, at some point you should at least have the thought in your head of, well, if I built this one and it was working and it works right away so easily, could I build a better one? Could I build a different one? Could I improve it? Was it just luck? Do I need to build other ones to have, you know, backup in case this one doesn't work in live trading? Don't become complacent would be the takeaway. But caveat to that, as the market's full of contradictions. Also, don't go too far to where you're testing 10 different entry rules, 10 different invalidations, 10 different targets. You can overdo it. There is such thing as overkill. So again, this comes down to knowing yourself. Some people feel better when they've, let's say you build a system A, with entry as the candle close, invalidation above the wick, targeting a gap. Okay. And you test that and you build it and it shows profitability. Some people will be okay with that. Other people are like, no, I want to try another one. You try another one, just so you have something to compare it to. A, B, split test. And maybe you try a third one. And after you've done 3, you feel confident, number 1, that you've done the work, right? You've gone over and above, you've done a bit extra work. So you just get that psychological feeling of having done a thorough job. You've got actual data. Now you've got 3 things to compare against. So you can actually see this is the best one, this is the worst one. And it will make you, for most people, for many people, it will give you more confidence and conviction to actually trade whichever one you choose to run with. Because it's not just, oh, I picked a fucking lucky toy out of the box. It's, no, I tested a bunch of them. This is the best one. So, for many reasons, you should take what I have here and try and expand it. Right, for an SFP, the entry for an SFP typically will be the candle close. You can also do a preemptive enter. So I will explain that here. Explain it here? No. Was it that one? That is for targets. Okay, cool. That's all good. Let's look at this this one here, right? Let's go back to this one. You have your price coming into the extreme. The typical way to enter here would be as soon as the candle closes and it confirms the swing failure, you enter. So right on the next candle open, you enter, stop loss at the extreme of that wick. Targets I'll come on to in a moment. We're just looking at entry and invalidation here. There's also a thing known as preemptive, which is as the candle is actually forming, you're getting in earlier. So how that would look, it's a bit more difficult to see, but basically you would enter on that day at that exact level. The idea being that probably using some lower time frame, by the way, like say you're on a daily, you're probably looking at this on also on a 1 hour or a whatever. But the idea being that if this is going to finish as a wick, then when it's down below, when it's down here, I obviously don't want to touch it. When it's coming back up and above, I could enter right on that level, with the logic being that we won't go back down to that area. And if it is a false breakout in SFP, we're going to go higher. So higher risk, because of course that's why the name is preempting. You're preempting it. You're getting in before the candle actually closes. And the risk obviously that poses is that this candle does not close as an SFP. It ends up closing, let's say, down here. And then you're fucking, well, you're not screwed, but you're definitely not in an SFP. And so that's something you should test. As always, the answer is testing. But you should compare, because why would you do it? The reason to do a preemptive is so that you can get a vastly better entry and you can have a tighter stop loss. Let's see if there's another example of an SFP over here that would be worth looking at. Was that an SFP? Initially it was, yeah. Here's a decent one. So you have a significant swing low, all right? Significant swing low that price had set back in June of 2023. We move all the way up, we move all the way down, and we have this massive swing failure pattern, okay? So the difference of waiting for the close versus entering preemptively, I'll just do this one over here. The difference in terms of your invalidation, let's just say both were targeting the liquidity above. The difference is vast, 1.71 versus 6.02. That's the reason for doing it. The reason for doing it is so you get a higher return potential. A tighter stop loss, higher return. It does not lower risk, far from it. Your risk should still be constant, your 1 hour, manage your risk. But the potential returns are higher. Now, that is double effect. Number one, that will allow you to have a lower win rate, which is good. I'm not saying you want to have a lower win rate, but if your average returns are higher on your system, it can afford to have a lower win rate. This system here would need to be, 50, 60% hit rate. Probably consistently well above 50, probably 60, above 60 if you could, to have a decent risk reward. Decent EV if it was all the trades were 1.71. This one, you could have a 30 or 40% win rate. But if you're getting 6 hour winners, you're printing. So the preemptive will be wrong more, right? Because you're not waiting for confirmation. So obviously sometimes you're going to be wrong. If you wait for confirmation, you're less likely to be wrong because you waited for confirmation of a candle close. But if your testing shows that even though you're wrong more, you make more when you're right, this can often be the better option. So that's what preemptive is. That's not the same as fucking FOMOing in thinking this is going to be this is going to... It's still disciplined and rules driven. I guess there's going to be questions actually. There's going to be the logical follow-on question of, well, how and where? So let's actually look into this. Like, if you're going to preempt it, where do you preempt it? Right? So if you're looking at a 1 hour, just on the 1 hour, it all happens in the same candle. Right? So if you wait for a 1 hour close, you're just as fucked. If you wait for a 15-minute close, you get one close below, which you wouldn't touch, obviously, and one close back above. So you're still fucked. So how do you actually do it? Well, When you have your key level, obviously, saying that you have defined it well, you've got your swing level, you could set your alerts so that when the swing level breaks, as it does here, your alert goes off. Your alert goes off saying potential daily SFP, right? Because it's obviously a daily swing level, price coming back down into it, potential daily SFP. And then you place your order just as a stop market order so that as soon as it comes back up, it triggers immediately and away you go. And of course, you put your stop loss in. The idea being, if this preemptive trade is correct, it's not going to go back there. The whole point of a preemptive trade is that if it's right, which is all you care about, if it's right, it's going to go straight up and you've better entry. If it's wrong, then that's fine. Because if we're saying this could be a 30 or 40% win rate system, sometimes it's going to be wrong. Take your loss, move on. Another way you could do it, which I think this example perfectly shows that you really shouldn't, is that like on a daily, you might say, oh, well, you could go on a 1 hour and execute low time frame. Well, even on this one, it didn't. You had no chance, right? So another way of saying it would be, you could look at, let's go back to this one. You could look at this and you could look at that on a lower time frame, such as a 1 hour, right? And you could try and execute it based on that. So you have a move down initially, price comes back up, closes on the 1 hour, comes back down, pushes again, comes up, rejects off it, comes back down, comes through. So unless you're going to use a completely separate price action system, like, you know, something like a kind of your under over pattern, which we don't really quite get there. We sort of do, right? You have a high, breaks down to the low, you break back above it, you come for the retest. If you're going to get into all that, you're adding a lot of complexity, which is fine. Look, if you can test it and find a way to get those entries better, all good, right? Because, you know, on this one, if you had that swing failure, because this happened right off the daily open, if you had that initial move down, you could have potentially been buying in here with a stop loss there and have gotten stopped out right away, right? So you'd have lost that trade. But it doesn't mean this couldn't be an SFP. Obviously, it ended up being one. It just happened later on in the day. So you may have taken, because there was no touch here, you may have taken a second market entry just right there, stop loss down there, and you would have took 2 stabs at it. Again, is it better to take 1 stab at it or 2 stabs? Is it better to just enter straight away? Is it better to wait for a candle close? Is it better to preempt? All of these things can be answered through, you guessed it, testing. You have to compare many instances, not just one lesson where I'm going through a small number of things to explain it quickly. You want to look at 20 daily SFPs and compare what would happen if you preempted it versus waited for candle close confirmation. Then look at another 20 in a different direction or a different asset or whatever. Another thing with this too, this is kind of a side note. A lot of this stuff, if you feel like you run out of data on Bitcoin, especially if you're on a higher time frame, just go and look at something like gold that has decades of price action history. You're not testing false breakouts on Bitcoin. And this goes for most systems. If you're testing something, right, unless what you're testing is very specifically to do with that asset. Most price action analysis is not directly to do with the asset. A false breakout happens on any asset. Because why? Because every single chart can trend and it can consolidate. That's not exclusive to Bitcoin. So if every single chart can trend or consolidate, every single chart could have a false breakout because that's just a failure to go from consolidation to trend, right? So when you're testing things like that are universal concepts, it's fine if you want more data, because it's much better to get more data, more instances. It's fine to go and test it across a different chart. I would say gold, because gold probably has, outside of crypto, because Bitcoin has the most data in crypto. Bitcoin has 15 years worth. I guess you could, if you want, go from Bitcoin to Ethereum, right? Because Ethereum, although many of the false breakouts will be at the same time, that's one of the problems with it, which is why I would not lean towards that, right? Again, if you're looking at daily false breakouts in Bitcoin, you do the last 15 years, you find like 15 of them, 20 of them, you want to test more, you go to Ethereum, you're probably going to find the same 15. So you're just going to end up doubling up the same data because the correlations have been very tight over the years. So are you really testing another 15 or are you just looking at the exact same thing again? That's the problem with going from Bitcoin down to Ethereum for something like a standard false breakout system or whatever. Moving over to something like gold. Gold is a scarce asset commodity-like. Bitcoin is a scarce asset commodity-like. Gold has a lot more price history. They're obviously compared to each other. That would be the next best thing, in my opinion. I would not do it on like the S&P 500, because that actually, if you look over 15, 20-year period, does not trade anything like Bitcoin. And in fact, it doesn't trend and consolidate the same way because there's different dynamics. The massive wave of passive investing, and this is really getting off topic, but I guess it's on topic. The massive wave of passive investing, where most people who buy into the S&P 500 or buy into the NASDAQ, they don't do so from a trading basis or a short-term basis. A lot of this is just people put in a percentage of their income directly, automatically every month. People invest. There's ETFs. There's mutual funds that are constantly buying. The rise of passive makes the stock market very much up only grind with interspersed corrections, which are generally quite fast and sharp, right? Bitcoin's not like that. And I don't think Bitcoin ever will be like that, because gold is not like that either. And if anything, over time, Bitcoin will probably go more like this. And gold is much more prone to trends and consolidations, right? And where the fuck? Why is this not? I want the gold chart. Surely it should go back beyond 2018. What the fuck have I done? Okay, they've moved that one to the top, right? Gold, you can see, is totally different. Gold is a very strong momentum trending asset followed by brutal bear markets. Sound familiar? Sounds like Bitcoin. Very strong momentum driven trending asset followed by brutal bear markets. Lots of consolidation, lots of chop. So I would say that's, your best cross comparison if you wanted to. Now that was definitely digressing. So where was I? Bitcoin. We did entry. Yeah, candle close and preemptive. So you now know what a candle close is, super obvious. You now know what a preemptive entry is, good. Invalidation. This one's really simple, first of all, like super simple, is just the wick, right? Beyond the wick. Then, obviously, as fucking everybody seems to do, and we've all done it, well, that wick's too far away. I want a tighter stop, so maybe I put it here, maybe put it there, maybe put it there. Problem with that is you're getting into a lot of what ifs, right? If you can define something objectively that allows you to use a better, tighter entry, then great. Tighter stop, then okay. The first thing you would look at, obviously, is the level it broke from. That's where the SFP was created. So if you're going to use a different stop, it absolutely has to be lower than that or higher on the upside. Has to be lower than that level, because otherwise it makes no sense. Because if you put it at the SFP level, well, the market can come back to that and still be an SFP, right? It can come back and retest that level, as it does over here, which, by the way, is probably the market going hunting liquidity of anybody who did exactly that. Shock. People who are too stingy, too greedy with their stops tend to get hunted. Now, you could attempt things like a candle range. And again, my advice is use the wick as it's intended. But if you're trying to test these other things, some of the things you could test. Range. So the range of the SFP candle. What is range? Get the fib tool from top, right top wick, to bottom, right at the bottom, and put it beyond 75%. That's obviously 25 on this, but you get the idea. 75% pullback of it. Why? Because it shouldn't go down that far if it's going to trend, meaning reverse. That could be one. That will at least allow you to pull in your stop a little bit more. Again, test it. Because what's the benefit of this? Well, if your target is up here, your original trade would be 3.25. If you add the 75%, it could be 6.15. It could literally double the potential. So if that also does not result in like halving your win rate, right? If you're able to potentially double your risk reward, as long as the win rate of those systems doesn't halve, it could be a good idea. Try it out. And then just try other things, right? Again, what matters? Objective rules. Wick failure is the exact same thing. Candle close that confirms it, right? Either wait for the candle to close or preempt it. Now, I guess it's not the exact same. It is slightly different. A wick failure is not as significant as a swing failure pattern, because wick failures happen all over the place. Right here, there's one, Here, there's one. So preempting these is very difficult because it's super easy to be wrong, and wrong quite a lot, and wrong, several times in a row. Because it's such a small move, quite often you're better to just wait for the actual candle close and trade it that way. But again, feel free to try it. The reason for that, by the way, a swing failure will have reached a significant level. Generally, it will be like a, higher time frame level that has not been tested in quite a while. That's why it's a significant level. That's why it's a key high or a key low. There will, in theory, be more liquidity resting below it or above it. And in theory, that means the reaction can be stronger. And that, again, in theory, means that it's more likely to be, once it goes below and above the line, or above and below the line, that it's not going to come back for a second stab. That's the theory. Doesn't always work like that, but it's more likely than just a regular wick failure. Multi-candle failure. Exact same. But I'll explain this one because it's slightly different in terms of how it looks. Candle close confirming or preemptive. So you're looking at your multi-candle false breakout. You're looking at the candle close, which confirms the false breakout, which of course this candle does not. This one closes right just above it. This one closes right down below it. But you can already see, if you're closing at that level, you've probably missed the meat of the trade. That's the risk, right? Now, on a multi-candle false breakout, in my experience, from my testing, don't take my word for it perfectly, because I haven't tested every coin, every time frame, but absolutely my experience with multi-candle false breakouts is entering these as it crosses the level with a stop loss above the candle that is crossing is a good strategy. So what does that mean? Right. Let me take this and we'll zoom in. So I want to look at it like this. If you're on a 1 hour chart or whatever, you're waiting for price to break through this level, okay? And you're keeping in mind your higher time frame context. So price comes down, comes all the way down, comes all the way down, comes all the way down. You're waiting for, remember, you will be waiting for a daily candle close, right? But of course, that takes us all the way down to here. So how could you enter it sooner? You go back to your daily, you look at it forming. There we see, that's the daily high of this current candle. Go back in again. We go right as it breaks. So as it was breaking there, I would enter based on that, okay? And I would have the stop loss above the last candle high. So the previous candle high, the daily one. Even if it happens like this, right on the open, technically the daily high is there. But as you're entering, you're using the previous candle's high as your invalidation. So that when you zoom out and you look at this, your entry and then your subsequent invalidation give you the best possible chance of success. Why does this matter? And why is this actually less risky than doing a preemptive, or sorry, doing a preemptive on a wick failure? Because when it's broken above and closed and stayed up there, or broken below, the trap has already happened. Right? It doesn't all happen in one candle. It's moved up, it's consolidated. So if it starts to move back below, it's far more likely that there are more trap positions, that the breakout is actually failing, and it's way, 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 way more likely to just follow straight through. Like to a significant degree. You've probably seen this yourself. If it's just a wick above or below, what happens? Just exactly what happened over here, right? How often have you seen this where it's just the wick and you see the false breakout and you think, wow, that's it, let's get short. And what does it do? It goes for another one. But when you have a multi-candle false breakout, it is so much less likely to actually come back. Because essentially it has spent a little bit of time to trap people, and then the flush. The way I view it is that there's just so much of an imbalance. The people went long. The combination of people going long and having to close, with also the sellers who sold, it can be overwhelming, and you see this gaps form. So I would look at that like, same thing over here. Here's an example of a multi-candle false breakout. right? First of all, starts a wick, closes below it, closes below it. As soon as it comes back above, right, as soon as it crosses that level, never comes back. Because it spends time above or below, the multi-candle is a much greater one. And you can see these, I mean, all over the chart, really. Multi-candle, false breakout, significant low, breaks below, 1, 2, 3. Now, if you just entered on this, if you just entered preemptively here, your stop's there, you're actually fine. You have to wait an extra day. But the point being, when it breaks down below it, and it consolidates below and it comes back above, away it goes. Multi-candle false breakouts, again, nothing's perfect. You can always get examples where the multi-candles, fail. This would actually be an example of one here. I wouldn't call that this is more of I wouldn't call this a swing failure. It's not a significant high. It was only set a few days before. But it breaks above, it closes. It consolidates, tries to come in. So you would have potentially shorted there. You would have potentially shorted there. And of course, you would get stopped out there. So it's not always going to work. Nothing ever will. But those multi-candle ones are, in my experience, multi-candle false breakouts are more profitable because they attract less speculative positions. Think about it. One of the first things you learn, if you just learn trading in a very kind of basic technical analysis sense, is you learn what a swing failure pattern is, you learn what a false breakout is, and it's always wick above, close below. And so, just like I showed, when people see wicks going above and closing below, their tendency is to just short. When people see wicks going below and closing back above, they go long. But so often you see price move back down or move back up to take out those levels. Just like, look at it over here. Sets a high, wicks above it, closes below it, shorts. What happens? Squeezes up, closes multiple candles above, and then the actual top happens. It's really simple. Let's call them uneducated traders, to be kind. Just people who don't really they haven't done the hard work like you guys are doing. They're not doing a lot of testing. They're not really thinking deeply about this stuff. They're just looking at, big wick equals, right? Big wick go long, big wick go short. Whereas when it's a candle close, they think the opposite. It's closed above. This is a breakout. I wouldn't even consider going short here because it's obviously a breakout, right? I wouldn't even consider going long because it's obviously a breakdown because the candle closes. Candle closes are what traps people into a sense of almost complacency. And last part here, targets. So I'll cover gaps first. Gaps are simple. Gaps are the best target, in my opinion, in terms of just knowing easily where price should go towards. Notice it should, not that it will. Nothing's ever guaranteed. Is it this one? It is. So you go into replay mode. Just taking a standard false breakout example here, right? So market breaks down, closes back inside. Where does it go next? Gap. So you have a false breakout, comes back inside. Once you've had that false breakout, look at some gaps. So on the same time frame, whatever time frame you're on, there's a gap. The gap is defined, again, by the area where price moves through with no retest. I have a lesson on gaps if you want to see it. That's the first place you should look at for price to go to. Why? Because the market tried to move aggressively. That's what creates a gap, right? A gap creates whenever the market moves aggressively in one direction or the other. So obviously the market's trying to go somewhere. It's trying to go down. If you then get a very clear sign that it's not going down, such as a false breakout, where is it likely to go back to? The place where the aggressive activity happened. For a couple of reasons. Back for shorts to fill more orders, or for the shorts who are down here to get squeezed, or just to retest the level, because inefficiencies just have this tendency to fill. And that's not a esoteric concept. That is very much driven by algorithms in the market, and Bitcoin over the years is getting more and more and more efficient. Meaning inefficiencies happen all the time, but they tend to fill. And they fill quite perfectly, as any of you guys who trade gaps can see. So you target the gap. What does it do? It fills the gap. Then after that, price goes off and does all this other shit. But that shouldn't necessarily have to concern you, right? The first place you're looking after a swing failure pattern or a false breakout or whatever is a gap. That's one area you can look at for take profits. Another way you could look at if it's a swing failure pattern, so a significant swing, This is, again, probably on your higher time frame, something like your daily. You're looking at this here. So you have the SFP, and you're looking at, okay, if this massive liquidation, big wick, closes back inside, where could that be expected to go? Well, take your most recent swing, so where it came from to where it went to, and use a fib and just say a 50 or a 618. So back to the 0.5 or the 0.618. Those, and I like the 0.618 for that, in that perspective, because whether it's going to turn around and be bullish or it's going to be bearish, it should probably and can still easily go to the 0.618. The 0.75 is much more of an indication that the market's actually reversing trend. So I wouldn't want to look at that first. I would look at the area where it can go 0.618 and it can reject and go lower, or it can continue higher. So the SFP is confirmed. You're looking at it to move through to 0.5, so retrace half the move, and 0.618. They're not magic, they're not special. Do you know what they are? Do you know why it's so good? Because it's objective. Because you can just say, this is the level. Do I need to care why it's the level? No. Do I care it's a golden Fibonacci pocket ratio? I don't give a shit. It's an objective level. Look at 0.5. That's just 50. Markets tend, and there's a real tendency, you see this with range trading, there's a real tendency for markets to move in equidistant levels, where if you see a breakout, it can quite often go 1.5 times as far. It can go often twice as far, right? So that's your 1.5, your 2. If it's within a range, you've got your 0.25, your 0.5, your 0.75, your 1. Anyone who's range traded can see how price does have a tendency to respect those kind of equal levels. And then, of course, your 0.618, that's a golden ratio, Fibonacci. That one has some use and some power because so many people use it. Loads of people do. Lots of algos are coded for it. Lots of traders use it. It's like Fibonacci trading is a very, very, very well-established way of trading. So if you know where there's going to be liquidity, good, target it. And what else on that one? This is obvious, but you can also target stuff like EMAs. That kind of stuff's simple. I'm not going to say EMAs or moving averages. By the way, it doesn't matter. SMA or EMA, it doesn't matter because you're going to have to test it. There's no better one. It's not going to go to the 50 every time. It's not going to go to the 100 or the 200. It's something you would have to define and then test. So in terms of a take profit, I don't mind it because EMAs or moving averages and EMAs are some of the easiest things to code. And I always like that from a perspective of liquidity. Because a little hint or tip about liquidity, meaning where will there be a buyer or a seller, right? Where will there be a willing buyer or a seller? Why do we talk about liquidity at extremes? Because if price goes above there, there's going to be stop losses from shorts and there's going to be breakout longs every single fucking time, just like there was here. Another place that there is reliably liquidity is on these moving averages, especially the more common ones, round numbers, 50, 100, 200, and so on, because algo traders, which is a vast percentage of the market, any prop firm or big trading firm or hedge fund or quant firm, any of them that are trading with sophisticated or just automated systems, many of the things they'll do is just simple commands like, if it's below the 50 EMA and they test it, sell. If it's above the 50 EMA, buy. So when it comes to these areas, it can act as a magnet for price. So that could be a place to exit if you want. Moving averages is always something you can use, so it doesn't need too much thought. The only logic, the only thing you need to know about moving averages as a target is that there is going to be liquidity there, because there is going to be somebody who has coded an algorithm to execute on the moving average level. As long as you're not using like the 493 period EMA, which probably no one's ever used, right? Again, that's my personal preference for why using round numbers and the commonly used ones make sense, but you do you. Some people like to think that if I use the 192 instead of the 200, I'm going to have some kind of edge because there's fewer people using it, so it's less crowded. I mean, in theory, that makes sense, but I don't view moving averages as magic level go boing. I view that they only go boing because people are buying and selling there, so I actually want the level to have more people looking at it. More algos coded with it. But again, that's everyone, each to their own. It's all about how you use it, right? Like I say, don't use a fucking hammer to butter your toast. Every tool has its own purpose. Okay. Wick failure. Gaps, same thing, right? Any reversal, any market that moves with an inefficiency, so there's gaps above and it reverses. If it reverses, look at the gaps. Same on the upside. Because if something fails to break out, it's going to go back down to where the people were betting. Where did they bet? Right before the impulse. The impulse creates the gap. It's a super logical place for price to go. And then liquidity itself. So this is a different way of using liquidity. Classic way you've seen me use it. So it's not. Don't worry, it's not going to confuse. Maybe it will. Will be like this. Your wick failure. So again, on your kind of lower time frame, if you were to enter here, right, and you entered short there, stop loss above the high, where would my liquidity target here? For me, this is super obvious. It'd be there. Why there? Because that's the lowest extreme that led to the new high. Right, so that's like, you can call that a swing low or an interim low. You can call it whatever you want. But it's the lowest point before this high was made. There's also levels in between. There's this daily low here. There's a daily low there. But if the market's going to reverse, and especially when it puts in that, it wouldn't actually be there, would it? It would be here, sorry. Market's going to reverse. Don't worry about the risk reward. Doesn't matter. Liquidity is like that, okay? If you go to literally any time frame, look for a false breakout, if we can fucking find one. Maybe not. I'll go to a 4-hour chart. Let's see something over here. Just trying to find one like at random. You want to see it move towards liquidity. Okay, here we go. False breakout here. You get your candle close. And liquidity you'd be targeting will be there. Right? Lowest point in extreme. Before that move up. Comes down. Eventually takes it out. These areas in between, if you can define them, like this one, which was the directly before the move up, you could define that one as liquidity and say, I want to see it take out that level. Fine. If you can find a way to define these, I find it's difficult because there's going to be lots of wicks on the chart. So you need to define it as a daily low or like this one, the swing low that directly leads to the move. You can define that as liquidity. But again, the concept of liquidity is a significant level where you know that there's going to be stop losses and breakout traders. So it has to be a level that is on the charts, it's visible. It's a key level such as a daily, a swing high, an interim high, a swing low, an interim low, a weekly low, whatever. Because that's where you know people are going to get long or short, and you can target that if there's a reversal towards it. And that's it. That's it for that part. And just again, just suggestions. There's loads more. Do loads more if you want. Q&A. G fucking M. Let's go into some questions. Okay. I'll close this off because questions, if you've been putting them in, we'll go through them now. GM. So obviously, I'm only going to answer questions that are relevant. Get to you. GM. Can this heat map of liquidations be used when looking for fake outs of spot clusters liquidation or price could dive and then reverse? Heat maps. My old enemy. So, yes. The theory behind this is fine. My problem with heat maps is that they're not accurately calculated. And I do have, by the way, you guys didn't vote for it yesterday. But on the open interest and data weekend workshop, it's going to include heat maps. My thoughts on them, exactly how they're calculated, and what I think of them. But let's assume a heat map was accurate. If you see price doing a false breakout into an area where there's high cluster of orders and liquidations, could that be used as confluence? Yes. The problem is, where? These are designed to be visually appealing. And one of my main problems with heat maps is that they look great in hindsight, like so much of the market does. They look great in hindsight because usually when you first look at them, you don't go and do a thorough, and this is not to say anything about you. I don't know what you've done. I'm not saying, and this is a very general comment. Most people don't actually go and research what the heat map is, how the heat map's calculated, and then go and rigorously backtest using the heat map. Instead, what tends to happen and why people love them is because when they first see it, it's like somebody's posted it on Twitter. And if they've posted it on Twitter, it's probably because it fucking worked. They're like, boom, hit the level, reverse. They're not going to post and be like, look, here's the heat map. It didn't hit the level. What fucking engagement is that going to get? So quite often the sampling is biased because people are choosing the thing that works, showing it on Twitter. And then you're like, that looks interesting. And so you decide to go over to like CoinGlass or whatever. And you decide to take a look at the heat maps, which again, is fine. Use anything. But you have to have a way of objectively testing it. And where is the fucking heat map? Am I on the right thing? Data. That's liquidity order. Where's the liquidation heat map? Am I fucking retarded or what? I am retarded. Liquidation price, technical indicator. Fucking game. Is it this one? Maybe it is. No. Okay. Where the fuck's the liquidation map on CoinGlass? Or have they put it behind a paywall? Yeah, live questions is closed, Mohammed. I'll only have time to go through the ones that are there. That is me right now. Okay, what the fuck? Yeah. Absolute boomer. There's literally a tab called liquidation. Okay, cool. Alright, so the other thing which you'll do is you look at something like this. You'll go to like a whatever, 6-month view just so you can get some data. And you've generally seen it on Twitter or somewhere else and you think, I want to check this out. And then you look at it and you're like, wow. Like the liquidations, it hit this level and reversed. Like, wow, it reversed perfectly off there. And it's really easy to bias yourself, essentially. Because you see this. Like, look at that cluster of liquidations all the way here. Price came up, hit it perfectly, and then reversed. Wow. And that was the top. It double topped, and then we go down. Wow. But your mind selectively forgets about this one, where it came up, bang, hits it, and what happens? Blasts on through.